Standard costing is like having a detailed blueprint for your costs, providing a clear and structured approach to managing your financial resources. It's a comprehensive system where you set predetermined costs for your products or services, allowing for better planning and control. These predetermined costs, known as standard costs, act as benchmarks against which you can compare your actual costs, providing a clear picture of your financial performance. Think of it as setting a target for what your costs should be, giving you a goal to strive towards in your financial planning. Standard costing isn't about predicting the future perfectly. Instead, it's about creating a robust framework for understanding your costs and identifying areas for improvement, ensuring you stay on track. By comparing your actual cost to your standard costs, you can spot inefficiencies, track trends, and make informed decisions to enhance your profitability, ensuring your business remains competitive. Standard costing is especially valuable in manufacturing environments where production processes are often standardized, providing consistency and reliability. It provides a consistent way to measure and control costs across different production runs and product lines, ensuring uniformity and efficiency. By analyzing cost variances, the differences between standard and actual costs, businesses can pinpoint areas where they are overspending or underspending, allowing for targeted improvements. In essence, standard costing provides a detailed roadmap for cost management, helping manufacturers steer their operations toward greater efficiency and profitability, ensuring long-term success. Manufacturing is all about efficiency and precision. Every dollar saved in production can directly impact the bottom line, enhancing profitability and sustainability. That's where standard costing comes in as a vital tool for manufacturers to optimize their operations, manage resources effectively, and stay competitive in a challenging market. Imagine a company that manufactures bicycles, a product that requires precision and consistency. They would establish standard costs for raw materials like steel and rubber, ensuring they have a clear understanding of their material expenses. Labor hours required for assembly, which helps in planning workforce and scheduling shifts efficiently, and overhead costs such as factory rent and utilities, which are essential for maintaining the production environment. These standards act as benchmarks for each bicycle produced, ensuring quality and cost effectiveness. Now, if the actual cost of steel rises due to market fluctuations, the company can quickly identify this variance by comparing it to the standard cost, allowing for swift action. This allows them to investigate the cause, whether it's a market trend or an internal issue, negotiate better prices with suppliers, or explore alternative materials that could be more cost-effective without compromising quality. Similarly, if they find the labor hours exceeding the standard, it could indicate inefficiencies in the production process, such as bottlenecks or inadequate training. This prompts an analysis to streamline operations, provide additional training to workers, or adjust production targets to better align with capabilities. By tracking these variances meticulously, manufacturers can maintain tighter control over their costs, ensure they are operating as efficiently as possible, and make informed decisions that drive continuous improvement and profitability. Setting standards is the cornerstone of standard costing. It is the foundation upon which effective cost control and management are built. This involves meticulous planning and a deep understanding of your production process. Every detail must be considered to ensure accuracy. The goal is to establish what costs should be under normal operating conditions. This helps in setting realistic and achievable targets. Let's break down the three primary cost elements: materials, labor, and overhead. This involves determining the standard quantity of materials required per unit of production and the standard price per unit of material. Accurate material costing is essential for budgeting. For example, a furniture manufacturer would define the amount of wood and fabric needed per chair and their respective costs. This ensures that material usage is optimized. This requires establishing the standard number of labor hours needed to produce one unit and the standard labor rate per hour. Labor efficiency is key to cost control. This includes wages, benefits, and payroll taxes. Comprehensive labor costing ensures all employee-related expenses are accounted for. Overhead costs are indirect costs not directly traceable to a specific product. They are essential for overall production but harder to allocate. These include factory rent, utilities, and depreciation of machinery. Proper allocation of overhead costs is crucial for accurate product costing. Standard overhead rates are typically calculated based on direct labor hours or machine hours. This helps in distributing overhead costs fairly across products. Accurate standard setting is crucial. It ensures that cost control measures are effective and realistic. If standards are set too loosely, they won't provide meaningful insights. This can lead to inefficiencies and to cost overruns. If they are too tight, they might be unattainable, leading to frustration and inaccurate variance analysis. Striking the right balance is key to effective cost management.